My name is James Simango, and I'm the principal of U.S Tech Central, and I've been practicing tax for over 10 years now. The company, we have been in business for just over 2 years. We specialize in cross-border issues, specifically between the USA and Australia. And in terms of experience, I've been working for one of the big four accounting firms, mostly in the USA. And now I do reside in Australia, and so US Tech Central is an Australian-based company. It seems the secret is out of the bag, and everybody is excited. And obviously, there are some good opportunities in the USA, and obviously that's one of the primary reasons why you're there. But we all know what happened that has caused us to be in this position. You know, that diagram quickly kind of summarizes what happened. We had a global financial crisis. Obviously, there was lack of planning on some parts of people in key industries, and it has created opportunities for both yourselves and other people also. And obviously, people would invest and are investing in properties in the USA. So it gets us to this position. The key concentrations on my discussion today is more or less in issues about tax. And that diagram is a pretty basic diagram. The key focus of our discussion today is about tax. And the slide that Joel is getting back to is just a basic diagram in terms of what we expect when it comes to tax. So normally what would happen is either yourself as an investor, you would purchase property in the USA. And obviously, if you've got property in the USA, you're sourcing your income from the USA. So therefore, the USA has got first taxation rights on the income that you have sourced in the USA. So, for example, let's say you source your income in Arizona, or let's say, or your property is in Arizona, or your property is in Georgia, or you have several investment properties that are just all over the USA. You'll be sourcing that income in that particular state, and that state is the state that you'd actually pay tax in. So it's a basic diagram. Where you're sourcing your income is where you'd pay tax. So we'll discuss a little bit more about tax. But what happens is what happens is when you pay your tax in the USA, what will happen is you'll get a foreign tax credit in Australia. So, or New Zealand. I understand there are some people from New Zealand. You are not going to be you're not going to find yourself in a position where you're paying taxes twice. The system reconciles on the taxes that have been paid in another country. So obviously, that's one of the key questions that always comes up and says, okay, fine, I've paid my tax in the USA. Am I going to pay tax again in Australia, or am I going to pay tax again in New Zealand? But that diagram is kind of self-explanatory, whereby based on treaties between the countries, you are not going to be found in a position where you pay taxes twice. So obviously we are going to meet some important players in the investment process. And on the next diagram, that is the next diagram, please. We have the U.S. foreign investors, of which you are foreign investors, and the next. Then along the way, we're going to meet a few friends. Some of them are interesting, and it's important to know who are our friends in this investment journey. And Joel, please next. So that's an important friend that we really have to get familiar to. That's the Internal Revenue Service, and obviously the Internal Revenue Service has been commissioned by Congress, and its primary job basically is collection of taxes and enforcement of tax laws. They are a very, very powerful governmental organization, and you know, I spent a lot of time in the USA, And I came to Australia in the last 2.5 years, and I've got to appreciate working with the ATO because I'll talk a little bit about the Internal Revenue Service. They're a very, very difficult organization to work with, and they are very aggressive in how they do things. So I just want you to take note in terms of understanding their capabilities in terms of making your investment successful. So we really have to pay good attention to their requirements. And next slide, please, Joel. So obviously, like I was saying, the Internal Revenue Service, they use a big brother, club type of approach, and so which means tax compliance in the USA is very, very important, especially when we are dealing with foreign investors. I'll discuss a little bit later on in the presentation why we have to file our taxes on time and why we shouldn't be late, because there are consequences for filing taxes on time. And the USA is a little bit different from Australia. They are very, very penalty happy. They like they like levying penalties. So for our investments to be successful, those are some of the key things that we want to avoid. We want to avoid paying unnecessary penalties. So just next slide, please, Joel. On the next slide, obviously you can see we have one of the familiar faces. I suppose some of you most probably you could have watched Snipes, the Blade actor. He's currently in prison for tax evasion and not filing taxes, and there are some horrible consequences for not filing taxes in the USA, and we just have to pay attention, and they are very, very aggressive. And most probably you'll get an opportunity to talk to some of the Americans who are in your presence to just discuss about how Americans view the Internal Revenue Service, and I think you'll kind of appreciate what I'm trying to communicate about how they work. So on the next slide, obviously, what we have is we have some of the common civil penalties that can be levied in the USA. Some of them, they have to do with failure of filing income taxes. We'll talk a little bit about there's estate tax, gift tax. In our slide, we'll talk a little bit about what estate taxes are or what gift taxes are, or how somebody might end up either having what we call an estate tax. Estate tax is a type of a death tax. Gift tax, I'll quickly run through what it is later in the slide. And failure to file tax returns has consequences. And also there are other things, most probably because of time constraints, but you have an idea that the payment of taxes is important, especially when we are dealing with foreign investors. There are special types of taxes which we call withholding taxes, but we'll discuss what they are and how and what are the implications. But regardless of the failure to comply, and the USA is a compliance-driven society, and it's very, very important that we comply. We'll move on to the next slide. So the next slide deals with why we need to file US tax returns. One of the key things that we do when we file your first tax return is we make an election. The election that we make is called a net basis election. What that election allows us to do, it allows us to deduct expenses that you are incurring in your business activity in the USA against your gross rental income. So it's not an automatic election that we just start getting this type of benefit. We actually have to make it on the tax return. So what happens is that, let's say if an investor is not filing their US taxes on time, the Internal Revenue Service can take away this election. And what it means that the gross rental income that you are receiving will be taxed on a flat 30% without the ability to deduct expenses. So obviously, if something gets to that position, then the investment becomes unfruitful, of which that's the reason why I've started off by emphasizing penalties and emphasizing the need to file before we jump in terms of structures or how we can make the money. But because the points about filing and the points about compliance, those are the key ingredients that are gonna make part of your US investment successful. So the idea is to avoid getting penalties. The next slide deals with important filing dates in the USA. A lot of dates that we have in the USA, they are 15th, March 15th, April 15th, September 15th, October 15th. So the key dates are 15th. When we have a holiday, they can push the day, the filing due dates a little bit. Like this year, we had April 18th because there were some holidays in the USA. But obviously, one of the key things that we, in terms of when we are structuring your investments and talking about filing dates, ideally what we've been doing, especially with a lot of foreign investors, is we've been aligning their investments with their home calendar years. So, for example, the Australian calendar year ends on the 30th of June. So we have an option when we are getting your tax file numbers to align your filing due date to be on this same calendar year, same fiscal year as the Australian tax year. What it does for you, really, it helps out in the sense that as an investor, you find yourself not doing taxes throughout the year. If you have a calendar year which is the traditional US tax year, what traditionally you'd find yourself doing taxes between January and April. Then just a few months later, you're worried about your Australian taxes. And obviously, some of the key issues that come up, especially when the years between the USA and Australia, or when the years between the USA and New Zealand don't align, we have to apportion the income from year to year. And what happens is we have carryovers from one year to the other. So ideally, when we are getting tax file numbers and structuring, we can structure those investments based on your Australian tax year. Ideally, that would mean that you concentrate on a certain period in the year just to do both your US taxes and your Australian taxes, and we avoid other problems that can entail with that, whereby we don't have apportionments. So we go to the next slide, where we meet another important friend. And that important friend, obviously, I think a lot of you are familiar with who our friend is, and that's the Australian Tax Office. What's happening over here is obviously you have foreign investments in the USA. We are dealing with the Internal Revenue Service in terms of the taxation of our income, but obviously the Australian Tax Office is interested in what you're doing in the USA. So, and obviously, we are in the formative stages, especially with a lot of Australians, or most probably New Zealand people from New Zealand also investing in the USA. So obviously, they might seem like they are not paying attention to what's happening, but you find most probably next year or in a couple of years, we'll start having certain issues that are coming out of either both offices, the Internal Revenue Service or the ATO. So with whatever we do, we still have to pay attention that we've got two tax systems that we're going to be dealing with. We're going to be dealing with the US tax system. Then we are also going to be dealing with the Australian tax system. And obviously for people in New Zealand, that's the New Zealand tax system. And what tends to happen is obviously our tax systems, they have similarities in some ways and they have differences, but otherwise you just have to be conscious that we have more tax systems that we are dealing with. So on the next slide just deals with an issue which I've just used already. There are tax treaties that deal with the taxation of income between countries, and obviously there is what we call Article 6 in the tax treaty that gives the United States first taxation rights to the income on real estate, and therefore Australia within the treaty has an obligation to give you a foreign tax credit. Largely I'm referring to Australia, but the rules that we are discussing are not going to be too different from New Zealand. So if I don't say New Zealand, for my New Zealand friends who are sitting in the seats over there, please forgive me, I've forgotten about you. But a lot of the rules are similar. We might have a few variances here and there. So anyway, like I said, we do get foreign tax credits. That's the most important thing to get out of the discussion about tax. The tax initially will be paid in the USA, and you get a foreign tax credit in Australia. And we'll bounce back a little bit to the US tax system, and largely you'll find that's on the next slide for the US tax system. Largely you find in terms of taxation, you'll be taxed on your US income from rental from the rental income. Then also you will be taxed on capital gains. Let's say in the year that you dispose the properties, there is capital gains tax in the USA. Just a little bit later in the slide, we'll just deal a little bit about the tax rates. What are the tax rates and capital gains, and based on different investment structures that you might have. And there is another type of tax, which is a withholding tax, and usually it is the best way to describe a withholding tax would be maybe it will be similar to the withholding that your employer would perform on your wages. So obviously there might be some withholding on your income in the USA, but when you file your US tax returns, you get a credit for that tax. So you're more or less prepaying tax. So in the event that you've overpaid, you always get a refund in the USA. So obviously, on the next slide, obviously, the US government, its objective is to tax you. And you as an investor, your objective is different. Your objective is to minimize these taxes, or better still, eliminate the taxes. So this is where issues like structuring really become important, because based on how somebody structures can determine how much tax they are paying. So structuring is very, very important, and just the taxes that are imposed, how taxes are imposed in the USA. Taxes in the USA, next slide. On the next slide, we're still dealing with the US tax system, where taxes in the USA, they are imposed on 3 levels. Taxes are imposed on a federal level. This is where the Internal Revenue Service governs what happens on the federal level. Then taxes are also imposed by the states. Like for example, if somebody were to invest in Michigan or in Georgia or in different places, or in Arizona, what you're going to have Arizona levying a tax. Then also we have some other type of taxes that are levied on a local government level. And so it depending on what structures that we have on a federal level, we have personal taxes, we have corporate taxes, we have capital gains, and I did mention a little bit about gift taxes. We won't concentrate too much on gift taxes. Neither will we concentrate on estate taxes. But what gift taxes are is, let's say, if somebody were to transfer the property to somebody either without receiving value for it, there is a tax in the USA for that. It's called a gift tax, and that's a specialized area. And failure to file those taxes, there are hefty penalties. And estate taxes, they have to do with if somebody passes away whilst they are holding US assets. We deal with US with estate in the presentation. The taxes that you're saying. And I did talk a little bit about the withholding tax. And as an investor, as a foreign investor, just make it a point to tell your property managers and whoever you're dealing with that you're a foreign investor, because there is some withholding rules in the USA when dealing with foreign investors, or when you are disposing property. There are some rules where a certain portion has to be withheld. What tends to happen is some property managers or some people you might be dealing with, they might not be aware of the withholding tax rules. So in the event that we have a foreign investor skipping on paying taxes or failing to file their tax returns, what happens is you can find the withholding agent in the USA is the one who becomes liable for the tax either the foreign investor hasn't paid. So obviously we just want to have a good system whereby, make it a point that you have this discussion with property managers or whoever is making payments to you, that are they aware of the withholding tax rules in the USA. Otherwise, it might present problems down the road. And the other quick thing, the next slide just deals with just basic tax file numbers. If an individual was to obtain a tax file number, we call it an ITIN. That's the closest tax file number we have to a social security number. Social security number is the traditional tax file number used in the USA, but as foreigners, what we get what we call individual tax identification numbers, largely called. That is on the next slide. Then the next tax file number is called an employer tax identification number, which is a business tax number. And usually when you have LLCs, you find you're going to have an EIN, but sometimes you find you'll have a need either to obtain both the individual identification number, which is the ITIN, or you have a need to obtain the EIN number also. As much as like in Australia, you have your own personal TFN, and you also have an ABN. So because of obviously with investment properties, you are in business in the USA. So the EIN is an equivalent of an ABN in Australian terms. The ITIN is an equivalent of a TFN. And we discussed a little bit about tax. You're gonna see taxes on state levels, and we have 50 states in the USA, and all those states, they've got their own rules. So obviously, the tax in all the 50 states will differ, but the key controlling tax return that you have is a federal. So a lot of states would base their taxation on what we have reported on the federal tax return. There are a few states in the USA that have got no personal income taxes, and they are listed below in that bullet point. We've got Alaska, Florida, Nevada, South Dakota, Texas, Washington, and Wyoming. The way they raise their taxes largely is through sales tax. And if somebody had invest in their own personal capacity, the only type of tax that they'll expect to see will be on a federal level. But we expect to be filing both a federal tax return and a state tax return. So it's unlike in Australia where we just file one tax return. we can file several tax returns. So let's say if somebody was investing in several states, let's say you're investing in 3 states, potentially uh, at a minimum you find yourself doing at least 4 tax returns. One tax return would come on a federal level. Then because you're sourcing your income in those states, so if you're sourcing your income either in Georgia and you're sourcing your other income in Arizona, when I say sourcing income, what I'm saying you're getting your rental income from that state. So the portion of income that you receive in Arizona is the portion of income that you declare on the Arizona tax return. So if I say sourcing income, I'm saying where you're getting your income, because sometimes we use some of this language a little bit loosely, but that's what I mean, where you're getting your income from. Then on a local government, on the next slide, the other type of taxes you see property taxes, and property taxes, council rates, and they are assessed by by the municipalities, and usually they are based on the assessed values of your properties. So sometimes, like, it's at the moment what you find is you find a lot of the properties in the USA, they have depreciated values. So obviously, because this type of tax is based on the assessed value of the property, so my assumption would be property taxes are supposed to come down, but I don't know. It really depends with the politics within the local governments in terms of how they assess these taxes. And obviously, the money is used for a variety of things within the state, paying for fire departments and schools and different things. So I suppose it's a good tax in that respect. That as long as we have all these other institutions, it keeps it might help in increasing the value of your properties in those areas. And obviously, then we'll deal in the next slides. We're gonna deal with the tax rates. Like, what are you expecting to be paying? What are the tax rates in the USA? So the next slide goes. It deals with tax rates. We'll talk about tax rates on an individual level. The tax rates would range between 10 and 35%. So as a foreign investor, you are taxed as a US citizen. The only few things that you don't get what we call standard deductions in the USA, but you do get exemptions that other US citizens would actually get. Largely, the taxation is more, you're taxed like a US citizen. And if somebody was to operate out of a corporation, the tax rates, they range from 15% to 35%, and they have wider thresholds. And so most probably, sorry for my slide, the blank portion, which is below the corporation tax, I meant to say trusts over there. And with trusts, they also range from 15 to 35%. But what tends to happen with trusts have got narrower thresholds. So what happens is, as trust quickly climbs up the ladder in terms of how much you are taxed within the trust. Still sticking a little bit with the trust, because I'm aware that some people are utilizing family trusts in the USA, family trusts from Australia, or family trusts either from New Zealand. Then the quick question that quickly comes there and says, James, wait a minute. I see that with individuals, they've got favorable tax rates. Then we are talking about corporations. They've got the tax rates. They've got a wider threshold. Then all of a sudden, I have a trust, and my trust has got narrower thresholds, and I quickly climb up to the 35% tax rate. Most probably, that's a question somebody would have mentally asked over there. I'll quickly try and address this situation with trusts. In the USA, we have a special description of trust. We have what we call grantor trusts. What a grantor trust basically is, I won't go in depth in terms of what a grantor trust is, but for people who have a family trust or who have discretionary trusts from Australia, just say your discretionary trust equals a grantor trust. The concept I'm presenting, even though I didn't put it in the slide, the concept I'm presenting is a very important concept in terms of understanding how you be taxed. A grantor trust is a disregarded trust in the USA, whereby the grantor trust is taxed using the tax rates of an individual. There are reasons why we describe it as a grantor trust, but I won't get into the reasons why we call it a grantor trust. But the key reason, just the key reason is because as a grantor trust, as the creator of the trust, the creator of the grantor trust is called a grantor. He has the power to revoke, to decide on a year-to-year basis what happens within the trust. So what I want you to take from what I'm talking about is, if you have a family trust and you have a discretionary trust, its equivalent is a grantor trust in the USA. One of the key things that has come out of with Australians investing in the USA is the understanding of how the Australian tax structure is accepted in the USA. So you might be talking with some people, and they might be having, if they might not be understanding exactly what you're really trying to imply or what you're talking about. But the issue of Australian trust is an issue which Australia specifically requested the US government to deal with in the US-Australian treaty. So there was an amendment that was put in relationship to Australian trust. But just re-emphasizing what I've just said there, discussing about tax rates, just an important point, just to make sure that people don't shy away from using family trust. There are reasons why we use family trust from Australia. Then the next slide just deals with the taxation of your profits. Let's say you dispose your property, and how capital gains are taxed in the USA. With capital gains, as an individual, just on the next slide, as an individual, as an individual, the maximum tax on capital gains is 15%, and for trust, the maximum is also 15%. And when I say maximum, I'm saying it ranges from 0% to 15%, because it's dependent on what is your marginal tax rate. So some people might find that they might actually have a 10% capital gains tax in the USA. But if somebody has a corporation, the corporation doesn't get preferential treatment in terms of dealing with capital gains. The corporation has graduated tax rates where it is from 15% up to 35%. So it's dependent on what is the annual income for that corporation in that given year, and that will be the effective tax rate. For a person to be able to enjoy the 15% tax rate in the USA, they need to have held that asset for at least over a year. If you dispose your asset within 12 months, then you don't get a preferential tax treatment for that asset. So obviously, you'll be taxed based on ordinary income, on ordinary income rates. So that's something just to take away and say, if you want to utilize those concessional tax rates, then obviously you have to hold that property for at least over a year. And we're going to go quickly, just discuss about the entities. And what I'll try and do is I'll try and tie in the entities that we are discussing with the issue of tax rates that we've just discussed. And obviously, one of the key entity, which I suppose some of you are familiar with, is the limited liability company. I'll give you just a brief description of what a limited liability company is, or why we need to have a limited liability company, or why not, or whichever way. A limited liability company is what we call a hybrid company. When I say hybrid company, it has an ability to become three things. It has an ability to become a company like we know it how here in Australia. So which means we can make an election when it comes to tax time to say we want our LLC, which is limited liability company, to be a company. So I'll say company as you know it how here in Australia. Suppose we know Rio Tinto is a company. So the LLC has that ability. We can people or two or more entities. But then the other third thing that it can be what we call a disregarded entity. So therefore, a disregarded entity is when we have one member, or if it was just James who became the investor in an LLC, then James is the only member in that LLC. And for tax purposes, I'll emphasize it, I'll repeat again and say for tax purposes, it is not recognized as an LLC. But then I'm going to put a big but. The big but I'm putting is it is recognized as an LLC for legal purposes. So the primary reason why we end up with LLCs really has got nothing to do with tax. It has got everything to do with asset protection. So we'll on the next slide where we do the advantages and disadvantages of the LLC. What an LLC is, it is a pass-through entity. So the way it functions is we have the LLC, and the LLC itself does not pay any tax. So what it does is the income in its character form is passed to the members. So we can have several members in the LLC. We can have James and wife, whereby James is a member and the wife is the second member. So what happens is James and wife, they are 50-50 members in the LLC. So what will happen is James will get his share of income from the investment in the LLC, and James will be responsible for filing his own tax returns. Then James's wife, Carol, will be responsible for filing her portion of income on that. So the LLC does not pay tax. It's a structure, it's a pass-through entity. It passes that income to the members. So when we have single members, so all the income is concentrated on one member. So obviously, that's the reason why the Internal Service would describe it either as a disregarded entity. But otherwise, as I've said, the key benefit that we will get from the LLC has to do with limited liability protection. Let's say in the event that somebody in the USA decides to sue you and you have invested, let's say, $50,000 in a property, and assuming you have one property sitting in this LLC. In the LLC, you can have as many properties as you want to be sitting in them. But what happens is that particular LLC is exposed to liability. That's the reason why you would find other people would have different LLCs whereby they are limiting their liability in the USA. So effectively, if you have 50,000 sitting in that one property, what will happen is that 50,000 is the only exposure that you have, and if somebody sues you, they only have access to that 50,000 in the LLC, which is either the one home or the two homes that are there. Then they don't have an ability to overreach to your other assets, either in other LLCs or maybe to assets that either has to do with protecting the assets and people not having an ability to sue your other personal assets. And in terms of disadvantages, well, there are not a lot of disadvantages with LLCs. And as I said, its functionality is more, it passes the income. But then the next slide discusses, let's say somebody who's a sole proprietor, somebody chooses not to structure anything. So when somebody, with sole proprietors, when somebody chooses not to structure, they are just like a sole proprietor here in Australia, where they can be sued, and they are several and liable for everything. So which means somebody can go after their own personal assets and things like that. Obviously, as a sole proprietor, it's cheaper to get into business, to get started and things like that. But the risks are higher in terms of your exposure to liability. But in terms of savings and things like that, well, a person truly can save a lot, but sometimes maybe when we're talking about liability and failure to protect your assets, sometimes we don't encourage people to invest directly in their own personal names. We prefer people to have some type of structures, then they can protect themselves from unforeseen type of activities. And also, personally, I suppose it's harder also, even because I know some of the investors, they have visions of either borrowing from banks and things like that. As a sole proprietor, then I suppose it might be a little bit harder in the US. Then we're talking about a C Corp. And some of the disadvantages, a C Corp, like I said, just a quick equivalence of a C Corp is how you would understand your Australian corporations, whereby obviously there are more responsibilities when somebody has a company than somebody who has either a partnership or somebody who's a sole trader. So with C Corps, which is on the next slide, they've got more formalities that they have. So, but otherwise, in terms of asset protection, the C Corp still gives you the same amount of asset protection as the LLC, but there are more responsibilities that arise from having a C Corp. And some of the disadvantages, like I've just mentioned, talking about disadvantage, which is the next slide, is the ongoing activities that you have, formalities and documentation, and there is potential of double taxation that can occur when somebody has a C Corp, because what happens is the corporation is taxed on a personal level. Then when those dividends are passed out to the shareholders are taxed on the dividends. In America, we don't have franking credits. In Australia, there are franking credits, and the reason for franking credits is to avoid double taxation on the income that you'd have earned in the US. Then the next slide deals with S Corps, S corporations. I think most probably some people might have come across S corporations in their reading. An S Corp is only for Americans. We cannot have any foreigners investing in S Corp. Then obviously there are penalties when we have foreigners in S Corp. So unless somebody in the room is an American, then obviously they can consider having an S Corp. But otherwise, we won't get into S Corps because is more targeted towards them. Probably I won't discuss this slide, which is here, which is the LLC and C Corp, and most probably I'll ask Stephen to send you maybe these slides, and you can make some comparisons in terms of what are the differences between LLCs and what are the differences between C Corp. So the comparisons, they are more self-explanatory, and they'll just help you in terms of getting an understanding what are the differences between LLCs and what are the differences with the C Corps. Then the next slide also deals with the differences between an LLC and a sole proprietor. I think you'll get these slides in some notes that will be passed on to you, and you can just kind of see what are the differences and what are the risks. And the next slide, I'll quickly deal with estate taxes and what they are and how we can avoid estate taxes. So obviously, if somebody passes away and they have US assets in their hands, they are subject to what we call estate tax. In Australia, Australia did away with estate tax in 1979. The USA, the rate for estate tax, I think, was 45%, and I think they brought it down to about 35%. But when something goes in through estate, it's gonna go through what we call probate. So on the next slide, it just deals with what it is. It's going to go through what's called probate. And obviously, when things are going through probate, you're going to be dealing with lawyers who understand either both the Australian law system and the US law system also, and legal system. And obviously, those lawyers don't come cheap. And then it also takes a long time just to deal with disposing or distributing those assets to the beneficiaries that will be left. So dealing with estate taxes is a key consideration that when we are structuring for investments, we really have to consider, because even though we don't like to talk about death, but what I can guarantee you, though it is unfortunate, within the next 5 years, we are going to have some Australians or some New Zealanders who are going to pass away, and they have US assets. And failure to structure for estate taxes, then obviously they'll be subjected to more taxes, and they'll be subjected to more compliance, which otherwise is going to eat away from those investments. So in terms of structuring for investments, that is one of the key considerations, one of the key reasons why we try and interpose foreign entities between yourself as an investor and the USA. We put in either Australian companies, we put in Australian trusts, so that there is a buffer between yourself and the US investment. That's how we get rid of estate taxes. So a direct investment, obviously your return might be higher because you don't have all these other setup costs, either for setting up LLCs or for setting up trusts and things like that. But obviously your exposures to other things are high. You've got exposures to gift taxes, you've got exposures to estate taxes. And we cannot foretell what happens in the future. The best way that we can prepare for the future is preparing for unforeseen events. And this is the level of structuring that you see tries and deals with the issues of estate taxes and gift taxes also. Then the other thing, obviously, it comes to deductions, because you're having investments. What deductions am I allowed in the USA? So the next slides will deal with some of the common deductions that we have in the USA. And you are already familiar with some of the expenses that we can expense from rental properties. Some of you have investment properties in Australia, so it won't be too new. What might be different is the rules of how we get it, how, that is what might be different. But otherwise, you're going to have advertising, legal expenses, tax preparation fees, commissions, depreciation, being deducted against your gross income in the USA. But obviously, the methods of how we deduct some of these deductions might be different. Like in the USA, we use what you call markers. That is the depreciation system that we use. It's different from Australia. And you would find enough talking about depreciation. In Australia, it's hard. If you have a 40-year-old property, you are not in a position to depreciate that property. But in the USA, it's based on how much have you put in that business and what is the asset, and your properties will be depreciated over 27 and a half years. And some of obviously interest, if for some people who have borrowed, who are going to be borrowing money or have borrowed money to fund these investment from the Australian fixed percent. So the best you might have is going to be the your Australian understanding of taxes. But obviously, we have a difference in methods. The normal type of deductions you get in the UK. And obviously, as in Australia and in USA, the importance of record keeping, which is the next slide we are dealing with, is very, very important, especially when we are dealing with audits. It's very, very important to keep your records. And as an investor, especially when we are dealing with issues concerning, especially with people who have got big loans, one of the big deductions that we're going to be seeing on one's tax return might be interest. And big numbers, obviously, they always raise questions, and most probably either the AT or the Internal Revenue Service might be interested in knowing, how are you deducting this? Where did you get the numbers? Do you have a loan agreement? Do you have a loan documents and things like that? So these are issues that can be discussed, on a different platform, but record keeping is very, very important. And obviously, because you get these handouts, and some of those, you get an idea in terms of how long you have to keep records and things like that. And on our website, it deals with the length of record keeping and other issues. And so, as I'm trying to wind up, we obviously this area is very, very wide, very, very broad. So I try to kind of put in a lot of material in a very, very short space of time, but it just gives you just a general idea in terms of what you're going to expect. But just as I wind up, one of the key things that we have discussed is the need to file US taxes on time. So those are some of the tips which are on the next slide that I'm giving. And also with your tax file numbers in the USA, give them only to people who need to be having them. Obviously, in this current environment, we have identity theft, and people can open bank accounts with your identity. And the other key thing that I want you to take out of this is the Internal Revenue Service never communicates with you through an email. So if ever you receive emails about certain things happening or whatever it is, they don't communicate to you through email. It's either you're going to get a letter, and that's the start off of that communication. So any emails that you get saying we are from the Internal Revenue Service, please disregard those emails. And just trying to summarize our services for US Tech Central. Like I said, we are a cross-border company where we deal largely with Australian and American issues. That's what we concentrate on and specialize on. And some of our services, we deal with pre and post investment consultation, setting up of structures, or when your structures are set up, helping you through the process in terms of what are your considerations, or when people are disposing properties, what are the tax implications, and what you need to do. Like I talked about withholding. For example, if somebody was to dispose their property in the USA, there is a 10% withholding on that property. You get that withholding as a credit when you file your tax returns. But with a lot of new rules, some people, they transact and they forget to do the withholding. For example, let's say you are buying a property from another foreigner who is already in the USA. The person who's buying the property has a responsibility to withhold 10%. So if you're buying a property from another Aussie, you have to pay that other Aussie 10% less because you have to withhold 10%. Unless if they give you a clearance from the Internal Revenue Service to say, I've already applied for income not to be withheld. So what happens is, for example, let's say if you don't withhold from the person who you are buying property from, and that person doesn't file taxes, what happens is you become liable for the taxes that they didn't pay. So obviously that's the reason why consultation is important, because you are dealing with new rules whereby you say, I didn't know, I paid him the full price, and this guy chooses not to file their US taxes, because some people will get tired and say, I'm done with US tax issues with US properties. I don't want to deal with US properties. I just want to sell. They sell and they don't file US properties. They don't file US taxes. And we are having another person buying, then this person has been left with a problem, but because they didn't know. And like I said, yes, we deal with structuring for overseas investors. And the other service, obviously, most probably will not relate to a lot of you. We deal with a lot of experts, especially US experts. More in summary, that is what my presentation is about. But the presentation, I wouldn't believe it would have done justice to the areas that obviously we need to have covered, because the area is so broad, and the USA is a compliance-driven society. So there are lots of rules that we have to pay attention to. So keeping in touch with your accountants, whether either on an Australian end or on a US end, is very, very important. And obviously, over time, you get to understand how some of the processes are. At the moment, my advice my advice would be, don't try and do it by yourself, especially in the beginning, because the USA is very, very penalty happy. Those tax authorities, they love penalizing people. And otherwise, so obviously, I'll just wait to get some questions, and I'll try and address some questions that might be in the crowd.